in the environment, it's always, I think, kind of a cool thing to do, to talk about, things like this, just because there are changes that are happening so quickly. So yeah, so this is me. I'm Jimmie Lenz, and I direct the Master of Engineering in Financial Technology and Cybersecurity here at Duke University. I am, my background is in more in trading and algorithmic trading in particular. I did that for a couple of decades before moving into risk management at one of the large banks and brokerage firms, and then headed up predictive analytics for a couple of years before coming back into academia.
And I am Lee Reiners, as it says here on the slide. I'm the Executive Director of the Global Financial Markets Center at Duke Law. Prior to coming to Duke, I worked for 5 years at the Federal Reserve Bank of New York, primarily doing large bank supervision, but also doing some policy development work with international standard setting bodies like the Basel Committee on Banking Supervision, the Financial Stability Board, and then domestically with the Financial Stability Oversight Council. I realize for many crypto enthusiasts, central banking is a dirty term, so don't hold that against me. At Duke, I teach several classes. One that is most relevant for this conversation is FinTech, Law and Policy. I also have a course by the same name that's on Coursera. It's a slimmed down version of what I teach, and it's designed to be accessible to a non-legal audience. So if you're interested in learning more about the evolving legal and regulatory landscape around FinTech, especially crypto, I encourage you to check that out. But my course, as it pertains to crypto, really covers how this is treated from a legal standpoint, both in the U.S. and abroad. What are some of the really evolving policy considerations? And I can tell you that it is evolving. There is no point in me preparing my slides, any more than 2 or 3 days in advance, because something will have broken in the news in the meantime that I'll need to incorporate. So it's a very fun class to teach, but it also can be a bit exhausting, because I can't just, like the old professor's trick where you just, dust off the slides every year. Doesn't work for this one.
I was going to say that is one of the interesting things about teaching anything in blockchain. I've noticed the same thing in my blockchain class, both the one I teach at Duke and the one on Coursera, is you can't dust off slides from last semester. This changes way too fast, and it's amazing how often, and I don't know if this has ever happened to you, Lee, that on the day of a lecture or right before a lecture, I'm still putting slides together because something just happened.
Oh, absolutely. It happens to me all the time. And, we have a class discussion forum, so we're always, commenting on what's going on in the market on the discussion forum as well. But good to be with you here, everyone. This is the third time, I believe, Jimmie, that you and I have done these. So maybe we have some repeat guests, but this time I think maybe it'd be helpful to take questions a bit sooner, and you and I can chat, Jimmie, but we also want to make sure we get to the questions that folks have. Obviously I can cover anything, policy, law related, and Jimmie's the tech guy, so we got all our bases covered here.
Well, I did want to raise one thing, because it was really interesting. It just happened last night. See what your thoughts were around. I mean, we talked a little bit about NFTs, non-fungible tokens. We talked a little bit about it last time, which was just 2 weeks ago. But the world's changed again, because last night one of the big things to be auctioned off was Jack Dorsey auctioned off his first tweet, and as most of you know, he was one of the founders of Twitter. So he auctioned off his first tweet as an NFT. I think it brought in $2.5 million. What's your thought on the NFTs and this craze that's going on?
Yeah, so I've kind of modified my thinking a bit, Jimmie, since the last time we spoke, because at its core, I mean, what blockchain and DLT allows you to do is create digital scarcity for the first time, right? And that's a very powerful concept, and sort of, we're seeing that applied to the NFT space. And so initially I thought, well, this is great for, for instance, artists that are clearly struggling right now because they can't, tour with the pandemic, and we all know that that's how musicians make money nowadays. And so, they have loyal fans who want to participate, and NFTs are a great way to do that. The Jack Dorsey thing and some of the top shots with the NBA, where you're basically buying a token that, gives you something that you can just view on YouTube or, online anyway. That to me, I would say is a sign of the times. So I kind of think that like a couple years from now, we'll sort of look back on NFTs the way we look back on like pets.com when we reference the .com bubble. I mean, I think it has, gotten a bit, I don't say out of control, but I think, like I said, it's reflective of what I'll call an everything bubble, where all assets seem to be inflated. We just passed the massive stimulus package here in the U.S. The economy appears set to, provided the COVID variants don't overcome our vaccinations. The economy is going to be running hot. It has been running hot. Stock market's at an all-time high. Housing market is rapidly increasing. And I think, NFTs is sort of the newest space where money's flowing into. There's just no way that, I mean, there's some like New York Post story about someone like sold like a fart as an NFT or something like that. I mean, it's just, it's completely out of control. But tell me, feel free to tell me that I'm wrong.
No, I think that, creating this digital scarcity and the supply and demand, the economic side of things, there is something to it. But when the artist Beeple, who now has the third highest auction price of any living artist, when he says we're in a bubble, you can probably take that to the bank, or maybe not. But I think that he's taking it to the bank. But I think that's very telling when somebody who's actually selling things is saying, "Hey, this is overdone," because as you said, you can view all this stuff on YouTube. Now you do own the right. I guess you could go to YouTube and say, "Hey, you got to take that down. I own that." Whether you can enforce that or not, you're the lawyer. So, but I do think that in some cases, there are some business models that this could work for. I think there are some streaming services that this might, this kind of thing might work for, selling limited editions of concert films, things like that this could easily work for, and possibly even, let the money flow back to the band, even on future sales. There was a really interesting story that was done, and it was posted on Medium, maybe a year or 2 years ago, by a guy by the name of John Walpert, who works for Consensus, on something called the bootleg token. That was basically that. It funded artists, and in a pandemic time, as you said, that could be something valuable. But for a lot of these, yeah, it seems like they are. You and I are in agreement. Some of these do seem just a little overdone. Even if Jack Dorsey can get $2.5 million for his first tweet, good for him. Hopefully he gives it to charity or something like that.
That's right. And to bring my analogy back full circle is, the .com bubble obviously wasn't indicative of the internet not having true value, right? So I do think that, when the bubble bursts, whenever that may be and however that may look, I don't think, all this stuff is going to go away. I just think it's going to be a little bit more rational, and we'll sort of see, the true value added, digital tokens, assets, whatever, will sort of, proceed long term, but a lot of the froth will go away.
Yeah. No, so, kind of along the same lines, because a lot of the tokens, people are either buying directly via auctions or, and I think the next iteration of that, they'll be on exchanges. And because you're an ex-regulator, and still kind of wear that hat a little bit, maybe on the side, it's on your hat rack, is this idea, I don't know if you saw Coinbase was fined this past week. They had about a $6 million fine, which in the big scheme of things for exchanges is minuscule, but it's still a $6 million fine over inflating some trading volumes. The way they calculated them wasn't, how we would normally calculate trading volumes. And so they were fined for that. In one sense, I think, that's probably a good thing. But to me, what seems like's happening is Coinbase and maybe Binance and some of the other exchanges, cryptocurrency exchanges, are just becoming more and more and more legitimate in the environment. The fact that they were fined for something like this, that one of traditional exchanges. And I wonder what you think about, one, the fact that they are becoming more legitimate, more accepted because they're being regulated as such, but also, kind of what you think about their business model, because it's very, very different than the model that we see on traditional exchanges. So I think New York Stock Exchange or NASDAQ or someplace like that.
Yeah, I mean, so there's a couple of things to unpack there. I'll just start with the business model piece. One is, for anyone who's used Coinbase, or Gemini can attest to, it's a very profitable business model. I mean, the transaction fees on these platforms are insane. I mean, especially when, I can go to my Schwab account or, Robinhood, trade equities for free. So I always, come back to this notion that, for a technology that was premised on, peer-to-peer transactions without an intermediary, we sure are paying a lot for trusted intermediaries here. The second piece is, I do think there is a maturation going on with these exchanges. They've been around for, quite a few years now, relatively speaking, in the crypto world, where, 5 years is a long time. So they've gotten more sophisticated, more capital, more human resources to deal with these compliance challenges, and they are challenges. I mean, they impose a cost for sure. The issue around inflated exchange volume in crypto exchanges is a well-known problem. I'm sure, as you're aware, Jimmy. Tether and Bitfinex, it appears as though, Bitfinex was using Tether to, prop up some volume on their exchange. If you go to Coin, because right now it's like, if you go to Coin Market Cap, right? Or there's, that's kind of like the gold standard. Like if you want to be as high as you can. And of course, if you are high on the rankings in terms of volume, then that attracts, there's network effects, right? So then that attracts additional customers and more fees. So it's good to see, it is a small amount that they were fined, but it's good to see that regulators are taking notice of this. I mean, the challenge, as I said in one of our previous Coffee and Crypto chats, is in the US at least, cryptocurrency exchanges, because they actually aren't facilitating the trading of securities. So, Bitcoin, Ether, these are technically commodities, and the cash commodities market is not regulated at a federal level. So there aren't all the normal standards and requirements imposed on these crypto exchanges that are imposed on securities exchanges, which are what we call self-regulatory organizations. They're actually endowed by the SEC with certain authorities and obligations to police manipulation and other abusive practices on their platforms. And so you've seen some attempts, I think Gemini tried to establish the Virtual Commodity Association, sort of, kind of like a FINRA, right, if you will, for these crypto exchanges, because they recognize that in the long term, it's better for them if, customers view them as sort of playing by the rules, right? And I know that drives some sort of crypto enthusiasts nuts, because, they hate everything, regulation. But we'll see what comes of that. I mean, I think, the moment there's sort of like a high profile, hack or, insider scandal, God forbid we have some type of Mt. Gox situation in the US, I think things would change dramatically from a legal and regulatory standpoint. I mean, Congress would, anytime, widows and orphans lose money, Congress takes an interest there. But we're definitely seeing a maturation in the market, and Coinbase, of course, is getting ready to go public, and so they want to make sure their house is in order. So I think it's a good sign.
Yeah, no, I think it's a great sign to see that. And honestly, I've asked this question before. I wrote a little article on it not too long ago around the whole idea of exchanges, crypto exchanges, and is this the kind of the natural maturation of an exchange? I mean, as we know it now, the New York Stock Exchange hasn't changed dramatically in structure in 250 years. It does pretty much the same thing that it did 250 years ago, just does it electronically instead of, with pieces of paper. But the structure of the exchange is just a meeting place is still there. That's what they do. Whereas the crypto exchanges occupy a very different type of space. They act as the exchange, but they also act as the broker, right? Because you don't go through a Merrill Lynch. You're not required to go through a broker to get to the exchange. You can go directly to the exchange, and then they also provide a clearing and settlement function. Exchanges here don't have clearing and settlement functions, right? They use the DTCC in the United States, and then they also provide custody services if you want them to. They'll hold your assets. So those are all things we pay extra for. If we go to a traditional broker, if we're working on a traditional exchange of any kind. And so I look at them and I say, well, wait a minute, they've significantly changed the function of an exchange. They've made it much more streamlined, almost instantaneous. And so it calls to me on one of the problems that occurred earlier this year was with Robinhood, and the big fine they're going to end up getting big fines,
yeah, it's coming.
Yeah, that's just in the books. But they had this real liquidity issue, right, with GameStop and the shorting, and part of that was just due to timing, right? Everything takes days and days to settle and to clear and all that kind of thing. But crypto exchanges, everything's it might not be instantaneous, but it's pretty close to instantaneous. You buy something, you own it. It's in your account or in your wallet at the exchange. It seems like a very, very natural way. So instead of thinking, do the normal exchanges start trading crypto? Maybe it's do crypto exchanges start trading other securities?
Yeah, I think that's a ways away. As I said, they're not, crypto exchanges are not registered securities exchanges. So to be able to do that, Jimmie, would require a pretty big lift. It's certainly not out of the realm of possibility. The other point that I'll make in regards to the Robinhood analogy, which I think people kind of are aware of now if they weren't beforehand, which is there's this old adage, if something is free, if a product is free or a service is free, then you're the product, right?
Yeah.
So the question we have to ask ourselves is what how are we able to trade on Robinhood for free? And basically now there's like zero commissions on E-Trade, you name it. And the reason is that basically our trading information is sold. So there's this concept called payment for order flow, which sort of got brought into the fore with the Robinhood situation, where Robinhood was routing its retail traders' orders to high frequency trading firms, most notably Citadel, who were then were serving as the market maker for those orders, essentially legally front running retail traders. For you and I, it's pennies, fractions of a pennies. It doesn't really make a difference. But of course, if you can do that on a large scale like Citadel was doing, then that's then you're talking real money. So that that model. So we have 20 plus registered securities exchanges in the U.S. Why do we need 20 plus? We don't. The reality is that they allow the exchanges to generate data, and they sell that data. That model doesn't apply yet to crypto exchanges. So I was kind of lamenting the fees. I actually think the fees make sense given the service that they're providing, not only executing my order, but as Jimmie said, I custody my crypto at I use both Gemini and Coinbase. I'm keep my coins in their digital wallet, whether that's smart or not. You be the judge. But I trust them more than I trust myself. And so that's a valuable service. Now, there is some indications that Coinbase in particular is starting to provide those sort of institutional grade services that the securities exchanges have been providing when it comes to data and whatnot. And that's something that I plan on keeping my eye on to see how big a part of their business that becomes. And essentially the risk is that you'd have sort of like a two-track system, right? One that caters to the wealthy, hedge funds and institutional investors that are getting into the space, and then the one for you and I. But for now, at least, it's just basically commissions is how they're funding themselves. But I wouldn't be surprised if they get into the data game. But I'd be curious to hear your thoughts on this, Jimmie.
Yeah, no. So I to your point, I think there are two things. One, I fully expect them to get into the data game because one of the big market data purveyors is going to come to them and say, hey, I want an exclusive on that. Thomson Reuters or, Bloomberg, or somebody's going to say market, maybe one of those guys is going to say, hey, I want exclusive on your data and I'll pay you a fortune for it. And everybody will have to do that. But it'll be maybe in a more consumable format. The other thing is, as far as selling your order flow, every brokerage firm does this, right? The Robinhood certainly not the largest. Charles Schwab is now the largest, right? With their acquisition of TD Ameritrade, they're by far the largest seller of your order flow. But everybody sells your order flow. Every brokerage firm does it, to some extent. Most of them do 100% of your order flow is sold, but all of them do it to some extent. But I do think that market data is the next phase of what we're seeing here. And as we see, more and more DeFi strategies and things like that, and so we're seeing, DeFi is starting to move into this new realm, right? Where you're starting to get more and more guys who are doing kind of my old job, algorithmic trading, and they're trying to do it with in the DeFi space, create those kinds of products. As we start doing more and more along those lines, that necessity of really well formatted pricing data it becomes that much more important, right? You can't just look at stuff, using an API works, but it would be really nice if I could aggregate it all together. Yeah. Right, and see what's happening across all these exchanges, and having the ability to do that, I think, is huge, because that will bring a couple of things. One, I think will bring a maturation of derivatives to the DeFi space, which we really, really need. I think it will also start the better ability we have to do that. We will start seeing volatility get arbed out of the markets.
Yeah. That's a critical point that you raised, Jimmie. And one that I don't think a lot of people realize is that sort of the law of one price doesn't apply to Bitcoin or crypto at this point in time. So if you were to go to even just Coinbase and Gemini, you would probably see two different prices on your screen. Internationally, it's all over the place. I mean, there's a well-known effect in Korea where the exchange prices there are higher. They call it the kimchi premium. And this is problematic when it comes to derivatives and price formation. So, in 2017, when we first saw cash settled Bitcoin futures come to the market, the challenge was, well, what's the settlement price? How do you determine that? Because again, there's no SIP, which is the SEC sort of standard price for securities. And so they had to construct these sort of elaborate price indexes, using multiple exchanges, and carving it up into time increments and taking the average of these increments, just because you don't want to have any manipulation, right? So you can if you can manipulate the index price, then you can obviously manipulate the price of the contract. So, so I agree that further, there's a need for these sort of traditional data services, and hopefully we can get to that law of one price soon, because it's just much more efficient.
Yeah, I mean, it reminds me a lot, and this is kind of harkening back a little bit, but it seems like crypto now is at the place where almost like we were in the early 1970s when the U.S. came off the gold standard, and no longer do we have a currency pegged to a commodity, so which basically takes all the volatility out. And at that time, there was this economist, Milton Friedman, who a few of you may have heard of, who came out with a couple of papers. But one of the papers said this will ensure a rapid adoption of a derivatives market in the United States. And it was just so that people could start using the currency with some sort of assurance of what the value would be in the future. And so, I mean, it would be great. I don't know if anybody on the call here today has thought about this, but a derivatives market is more than just betting, right? This is a way to take some of the volatility out of things, but it's also the way that things become more institutionalized, where companies become a little bit more comfortable using something when they can take the volatility out of it, so they have some assurance that if Bitcoin's worth a certain amount today, they can in some ways protect themselves or hedge themselves against a move, in a month or 2 months, and that will, to me, that will probably be needed before we see more of this international adoption, or global adoption of specific currencies.
Yeah, and to follow up on that point, and encourage folks to put questions into in the chat here, because we're about halfway through. Um, I think on our previous call, Jimmie, I was sort of critical of the idea of crypto derivatives, and I still am, because I just don't think that there's really much of an economic purpose yet. I think these are just mainly means of speculation. Um, the reality is that a lot of people don't actually want to own, physical Bitcoin. I mean, I know it's ironic that we use the term, but for lack of a better one, because you have to, keep your private key secure, and there's a lot of people don't want to deal with that, but they want exposure to the price of Bitcoin, and so they can get it through sort of a more traditional liquid regulated instrument. They would prefer to do that, and so so I mentioned, we already have, Bitcoin futures contracts, both cash and physically settled. There's Bitcoin investment funds. Grayscale is Grayscale is the most well known. That's OTC, OTC only. So accredited investors, you and I, well, I'm not accredited. Jimmie might. He made a lot of money in the private sector. Only have access to the Grayscale, but the Grayscale at the time was trading for a pretty significant premium, right? Which was reflective of this idea that people prefer to get their exposure without having to keep private keys secure, essentially. So I think there's just a lot of hurdles that need to be overcome. Now, I think that I'm not saying never. We never want crypto derivatives, and we are kind of slowly getting to that point where there might be economic utility. I recently wrote a blog post called "Beware of the Bitcoin Balance Sheet," where I highlighted. So Tesla made news recently when they announced that they had bought 1.5 billion in Bitcoin. We're gonna, it's on their balance sheet now, and they're planning on accepting Bitcoin as payment for cars at some point in the future. MicroStrategy is another firm whose 70% of their assets are in Bitcoin. So that's a situation where they actually probably do have a legitimate hedging demand there, and I would imagine other companies will follow them shortly. Now, I don't think that they should, for a lot of reasons. I mean, if I were an investor in Tesla, I would say, well, you should be making like really good cars and selling cars. Like, I can invest in Bitcoin on my own. I don't need you to do it for me. But setting that argument aside, I mean, I think, as more sort of traditional companies, if you will, get into crypto and have crypto on their balance sheet or accept it for payment, then we will need derivatives. And I just don't know the pace at which that will proceed, though.
Yeah, I mean, I think it's interesting when we look at companies like Tesla or MicroStrategy that are investing retained earnings. Well, I guess in Tesla's case, it's a little bit different because I don't think there are any really net retained earnings, but retained earnings in things like cryptocurrencies. I mean, I would make the argument that I would be more comfortable with a company doing that than using retained earnings to buy back their own stock. If the best idea you have is to invest in your own stock, you're out of freaking ideas. And so I look at almost every firm right now that's out there that is making, that use the tax break under the last administration to buy back their own stock, is basically they're out of ideas. I would be worried. I would be very worried. Part of it, I think, why you saw the stock market continue to go up is because of, just what you said, Lee, a scarcity. It's a scarcity play, right? There are fewer and fewer public assets for people to invest in. And as that continues to happen, people are going to look for alternatives. And so I think that's one of the reasons that at this place in time, people have looked maybe with a different view towards crypto assets than they would have, when there were 9,000 publicly listed securities in the United States. Fewer things.
Yeah, that's a good point. There are fewer things for the average Joes to invest in, and crypto is one of them. It's crazy how it's just captured the zeitgeist of so many people. Like people that you never would have imagined coming up and talking to me about, how they bought, XRP or whatever, token. They've done their research into it. So, so it is fascinating. I mean, one thing that, not to put cold water on certainly the great work that you're doing, Jimmie, but I do kind of worry about the influx of very talented and smart young people who are sort of treating this like it's like the new gold rush. it's kind of like back in like the 90s and early 2000s when you had, people with PhDs in physics going to Wall Street to, structure derivatives and, mortgage-backed securities and other securitized products. I don't know if, from a societal standpoint, if that was the best use of their skills and talents. And I'm also seeing a lot of very bright people go into crypto with no apparent purpose other than make tons of money, which, it's America, you can do that. But I do worry.
Well, I think that one, I don't think there's anything wrong with making money, but but I do think that there are some different drivers. I'm surprised at how often those people are coming up to me and saying, "Hey, what do you think about these coins?" Or "What are you thinking about this?" And they're 40 and 50 years old. They're not 20 or 22. They're much more mature, and they've had a chance to see different things, and yet they're still excited by this technology. But I think for younger people going in there and having the opportunity to kind of reinvent certain financial products and things like that in this way, I'm kind of fascinated by that. Probably more so new things and things that give people exposure. I mean, one of the things I would love to see is, we're just starting to see it via NFTs, and I think NFTs are, to me, it's a little bit more bragging power. It's like, yeah, I mean, I can go buy a picture, I can go buy a great print of the Mona Lisa. I'm never going to own the Mona Lisa, right? It's going to be in the Louvre forever. But hey, there's an ego thing. But if you own the original, you own the original. And so there is a little bit of an ego play, I think, in some of the things that we see in NFTs. But I own that. Well, yeah, but I can go watch it on the internet. Yeah, but I own it. Okay, big deal. But sometimes that satisfies a lot of people. But I do wonder if we start seeing this being done, and I talk about this a lot in my classes. Other things being tokenized that do provide, I think, more exposure. There are people tokenizing homes, people tokenizing commercial properties, people tokenizing things, and that's a little bit away from crypto, but not really, because it's still providing, I think, the kind of the average Joe the ability to maybe invest in things that they couldn't before. Crypto kind of gives you the ability to invest in certain projects that normally or 10 years ago you couldn't have done.
No, I certainly agree with that, and I think to sort of back up what you're saying, and not to totally be a Debbie Downer, is I think it's great that people are interested in asking questions about aspects of our economy and financial infrastructure that previously no one thought twice about. I mean, literally, right. What is money? Where does it come from? Who can issue it? What is its essence? How do payments work in this country? And the fact is that the U.S. has a very antiquated and broken payment system that exacerbates wealth inequality. So, if these are issues that you're concerned about, then I think it's great. So I think that part of it is fascinating. I think it's just the people who are saying, well, I can just tokenize whatever and make a ton of money, or do NFTs and make a ton of money. That is the part that concerns me. But Lord knows there's a lot of aspects. I mean, one of the things that's frustrating, and this is just part of like our general discourse nowadays, is like everything is like sort of binary. Like you're either for or you're against.
Right.
And that's not how I feel at all. I think a lot of people, when they hear me talk, and I express concerns or sort of criticism, think that I'm somehow like anti crypto and that this is going away. And that's not how I feel at all. It's it's, as you said earlier, it's me grabbing my little regulator's hat and putting it on and saying, okay, I see the benefits here, but there are also like a lot of risks that we need to like control for and think proactively about from a policy standpoint, and not just be reactionary, which is the historical stance of most regulators. But I think things are moving so quickly here, and there is a bit of sort of competition with other countries too, that I would like to see policymakers think a little more proactively and strategically about how we want to position ourselves if this is the future of money and finance.
Well, you know, yeah, I mean, there are obviously there are going to be there are going to be changes, and people are going to think about things in a couple of different ways. But I do think that there are, you know, it's an interesting way to think about it. I have a question here that came directly to me. When I talk about global adoption of certain currency, what would be the incentive for corporations, governments, government entities across borders to choose one crypto, given the limits of speed and legacy? Okay, so if you take the idea of speed out of the equation, okay, and that's something that we can take out of the equation. We're getting past that. We're starting to do some different things. So the advantage of being able to do this is you lose all the frictions that are involved in multiple currencies. So I've told this story before, but I'll tell it again. So I have a friend who has a company that sells or leases rather these self-contained kits, right? That he sells in Africa, and in the kit, basically what it has is a couple of solar cells, an inverter, a battery, 6 LED lights, and a phone charger, and you rent that for a few dollars a month. The problem is he does that mainly in the Congo, where he receives Congolese francs you know, in that's what he gets paid in. But he's here in the U.S. And so he can only deposit those Congolese francs in a bank that's owned by the Roman Catholic Church that charges him 12% to make that deposit. Oh, and by the way, he can't really get the Congolese francs out of there very easily. And his suppliers for some of the parts that he's putting into this self-contained kit are in China. So now he has currency that he's taken in Congolese francs. He has to convert them to USD. He has to convert his USD to renminbi to pay his Chinese suppliers. And then he has to do the whole thing back around again. And then he's paying all these fees, right? There's all these transaction fees. What if he had one currency that he could take in his payments in? He could report in that currency. He could use that currency to pay his suppliers in China. And then, you know, he wouldn't have all those frictions. So he could probably lower the cost for everybody a little bit. He would eliminate all those frictions, and he could use one currency. Now, governments aren't keen on this, right? Because they want to be able to control their currencies. So governments wouldn't be a fan of it. But for corporations, this would be a great idea. JP Morgan Chase has kind of done this a little bit. They have what's called the JP Morgan Chase coin, right? And they use this for internal purposes. And so, and they've never disclosed exactly what they're doing with it, but I'm guessing that what they do is they convert everything, and the JP Morgan Chase coin is like a stable coin. It's worth $1. They're converting everything to that so that they can take in all these other currencies. They don't have all the friction of actually transferring into USD. They can convert them into this currency, cryptocurrency they have, and report that way. That maybe, you know, maybe kind of facilitates things along in a very different way. You know, it's very, very different in, you know, way of thinking about things. But I think those are the kinds of things that, you know, that we would like to, you know, eliminate. And that's one of the things I think that crypto, that's one of the things I loved about Libra, which I know you hated, Lee, but I thought Libra was such a great idea, just because of being able to do something like that.
Well, Libra is a nice transition to a question that I got directly from Max in the FinTech program, who wants to know if central banks view crypto as a threat to their ability of conducting monetary policy and controlling the currency. And then how does crypto impact FX markets? So, you know, I would say that prior to Libra, the answer was no, that the Fed and probably most other central banks were not too concerned about cryptocurrency. But Libra was a game changer for several reasons. Primarily was Facebook's scale. You know, so you know, Facebook in essence is its own online, you know, government community. Over 2 billion active monthly users. Clearly, they have the tech talent to make something like this operational. And so I think central bankers realized pretty quickly, and policymakers too, certainly the US Congress recognized that if this thing were to get off the ground, it had the potential to scale very quickly. Now, I think had that happened, you know, sort of the most impacted would not have been the U.S. right away, at least, but it would have been, many of the African countries, like Jimmie is referencing the Congo, for instance, where people do have mobile devices. They have access to, WhatsApp, Instagram, Facebook, whatever. And sort of Libra could have become the de facto medium of exchange in those countries like very, very quickly. So you saw a whole bunch of initiatives put forward by central banks and by the Financial Stability Board, the Basel Committee afterwards, that were sort of clearly designed to sort of counteract Libra, and also to get central banks themselves to start thinking about, do we want to have our own version of a cryptocurrency, a central bank digital currency? And so the Basel Committee recently did a survey, and pretty much at this point, every central bank is at least thinking about this. Now, some are further along. Some have actually done trials, most notably China. The Fed is looking into this as well. But we're still a long ways away from, the dollar's, reserve status being incredibly challenged by crypto. So I think stable coins are kind of probably where, to keep your eye on in terms of international payments. And if it's the case where it's a one-for-one stable coin that's back, tied to the dollar, that's just a different, that's not going to challenge the dollar status, right? It's just a dollar in a different, a different package. So,
I'm gonna posit something a little bit different. I think I agree, Lee. I think that the stable coins are just a dollar by another name for the most part, in particular since they are supposedly all escrowing the money. So I mean, it really is a one-for-one type thing. One of the things that so hopefully that answers your question about the advantages of using a kind of a global cryptocurrency in that it takes a lot of frictions out of. And it facilitates, I think, a lot more international business. But along the lines of some of the things that, okay, so we off how do you explain the emergence of the NFT art store? About we talked about this a little bit, Jeffrey, but I think that Lee and I we did talk about some of the things that are going on. I think there is a bit of a bubble in the NFT space, but I think there are a couple of things that are happening there. It is providing, I think, people with a way to own things that they couldn't before. I mean, the NBA has, I think, been the they've been very, very free about selling footage, and people can own something. So I think there is a little bit of an ego thing. We could always go and buy prints of famous artworks and things like that, but we don't own them. We could go hang, a Van Gogh on our wall, a print of a Van Gogh on our wall, but we don't own it. So there's that, I think, that ego thing of actually owning it. I own this LeBron James dunk, the footage of it. Could I actually enforce my ownership? I don't know. That's more of a Lee question. He's the attorney, but so I think there's a lot of that. But even, as I mentioned earlier, the artist Beeple has come out and said, we are in a frenzy. Absolutely no doubt about it. This is a frenzy. This is a bubble that we're in, and it's going to come back. It's going to come back in. That said, I'm sure he was happy to get his $69 million for his artwork, but nonetheless, I think that's probably the case with NFTs. But what I was going to raise is this idea of being able to tokenize certain assets. And you brought up the Federal Reserve and some of the banks. If we did start tokenizing assets, in particular assets, like homes or commercial buildings, things like that, something that I can see as very, very plausible. I know this is being done on a very limited basis now. That I can see that would, if that caught on, I could see the Fed being more upset by that than the use of a global currency, because all of a sudden you're taking currency out of the market, as you sell assets directly, as you start doing almost crowdfunding of homes or other kinds of property, and you're taking commercial banks out of the equation, so commercial banks can't continue to make money. I could see that being much more upsetting to the Fed, something along those lines. I don't know about your thoughts around that, Lee.
Yeah, that's a great point that you just brought up, Jimmie. And I think we're still in the early stages of central banks wrapping their head around, what does crypto adoption in all its forms mean for monetary policy implementation? Because as you said, right now, monetary policy in the US is primarily implemented through the commercial banking sector, right? So, just as for a simplistic model, when the Fed wants to, increase the money supply, it buys, treasury securities that are held by commercial banks, and then commercial banks are supposed to sort of lend that currency into the quote unquote real economy. Now, of course, that, like I said, that's a very simple explanation, but that's generally how it works. And Jimmie's right. If commercial banks are sort of being bypassed now for payments or whatever it may be, that's going to have real implications for how monetary policy gets implemented. And I think the Fed will have to adjust. And that's one of the reasons why some central banks are interested in the central bank digital currencies, because they can, in the code itself, actually write in monetary policy. So they can, give the token holder an interest payment, or, actually take away some of the value of the coin, which, of course, is frightening depending on your point of view, right? So you could have negative interest rates, which is something that actually is in place in Japan and in Europe. So yeah, this is all something that we're all struggling to. The central banks are struggling to understand.
Yeah, I know, I agree, and I think, Raphael, your question around being able to use NFTs or something else, it might not be an NFT necessarily, but a token that would allow you to buy property and things like that. So these are being used in a limited way right now to help people, in particular, around homes, tokenizing homes. So think about it this way, and I talk about this a lot in my course, is this idea of say you buy a house for $250,000 and you tokenize it, and you say, I'm going to sell 199 tokens in my house. I have to buy one. I'm going to sell 99 tokens in my house. And you would, and basically those other 99 people everybody would own 1% of this house, right? And so the person who lived in the house, they would own one of the tokens, and they would pay the other token holders and what we would call as an interest payment that would flow directly through to those tokens, right? And so for everything, every payment they made above the interest payment would allow them to buy back some of the equity. That's where it gets a little bit tricky, because in the United States right now, the way property is registered in every state and literally every county is a little bit different in the United States, and that's over 3,000 counties. There are 3,000, a lot more than that. Counties in the United States, that it would be hard to adjust that in the way they keep books and things like that, because it's really, really antiquated. So that might be a little bit of a challenge. But this kind of an approach is being used on a limited basis in some places right now, and you can see where, if you were just a regular investor, this might be a really popular thing. This might be something that would be really attractive. Hey, I want to buy 1% of 10 houses. It'll cost me, say, $25,000, but I'll get a cash flow from that. These interest payments. And when the house is sold, if it's sold at a profit to where the person bought it, I would be entitled to 1% of that profit. Now, if it took a loss, you would get 1% of the loss. But it's this idea of mutualizing the risk and the reward. And I think that's what investments in companies was supposed to be originally, was this idea of mutualizing the risk and rewards. It doesn't really work like that anymore, but that was certainly I think the intent to begin with. I'll get off that soapbox right now, but I don't know. What do you think about that?
Yeah, so people like to talk about sort of tokenization of real assets as kind of a solution to poor governance, really. And I think that's the wrong way to think about it. I mean, at the end of the day, in order for this model to work, for tokenization to work, you're going to need a court system that is credible, that is independent, and that is willing to sort of adjudicate these disputes, because you're not going to be able to code for every contingency, for every conceivable dispute. And ultimately, these things are going to come to a court. And the court is going to have to, recognize, ownership and the establishment of a contract via the smart contract, right? So, so I don't think, tokenizing deeds for instance, in the Congo is a credible proposal. Now, it is credible in the US. There's a lot of just sort of kind of impediments from a policy standpoint that are not insurmountable. But it's only going to work in the countries where you have an established rule of law.
Yeah. So a question came up. Don't we already have REITs for that? And I would argue that REITs are a little bit different. One, you can't choose what the investments are. It's whatever the REIT chooses the investments are. Secondly, there are fees upon fees in REITs, right? Because you can't buy them. You have to go through a brokerage firm, and then there's the REIT management company. So most of the profits, most of the cash flows are brought back, but but you don't share in any sort of ownership of the underlying asset. So any sort of gain or loss, hopefully gain, you wouldn't really share in that. The REITs are structured, and obviously REITs have changed a lot in the last decade. Where I remember years ago, I'm thinking more of single family REITs, although they have apartment REITs and all that kind of stuff too. Single family REITs, you can't choose what goes into those, of course. And they started off, I remember they used to be about 8,000 or 9,000 homes in one of those. Now there are like 50,000 homes in one of those. So if I wanted to invest, say, in homes in my neighborhood or in my town, there's no way I can do that through a REIT. So I think it's more of an it's a different kind of product. I think it certainly, I think, is sold on that basis, but I don't know that it would be bought by the same kind of people that have the same kind of interest. That would be my take on it. I mean, Jeffrey, you're probably very familiar with it, but that would be my take on it. And then, of course, there are the fees on top of it, which are always a little bit precarious for some people.
Yep, I would agree with that. And then I see Parul has a question about what are your thoughts on countries trying to ban cryptocurrency? So I would imagine most people are familiar that India recently wrote out a law. I don't think it's been enacted yet, but they're proposing banning individuals from using cryptocurrency. My feelings on this are mixed. I mean, first, it's totally expected, and I'm surprised actually that it's India's sort of the first country to do this. I thought it would have happened sooner by now. At the end of the day, control over one's currency is a fundamental element of sovereignty. So if you ask someone, what does it actually mean to be a sovereign entity? You would probably list in your answer, control over, the currency. So I do view sort of mass adoption of cryptocurrency as a fundamental threat to sovereignty. And so from that standpoint, it makes perfect sense that a country like India would try to ban it. But I just don't think it'll be very effective because the whole premise of the technology is that it's outside anyone's control. So in many respects, it sort of fuels further adoption by proving the point of going back to Satoshi's white paper, right? So I just don't think it'll be particularly effective. I think if India is concerned about about their financial system, then they should focus on structural reforms and the rule of law and establishing an independent central bank that is credible, as opposed to trying to ban alternatives.
Yeah, I'm with Lee on this one. He and I disagree on a lot of things, but not this one. I would say, yeah, good luck with that. How are you going to do that? I mean, just by their nature, obviously these are anonymous. Unless they start monitoring web traffic, which there are some countries that can do it. China's not, or India's not one of them. And so that would be a monumental task to try to do something like that. And even if you could, that we all know there are a lot of ways around that. So I think it would be almost impossible. I mean, they can make any kind of claim they want to, but it would be almost impossible to do that, just given the way that we do things. Now, obviously, if people are doing things through exchanges and stuff like that, there are certainly rules around that, but it's by exchange, right? And they're not like universal. And so it would be a monumental task. I think there are a lot of things they can probably do inside of certain economies, but trying to do this would be almost impossible, I think, for almost any place. Not every place, but almost any place. It would be about impossible. And we have time probably for one more question. I know we're almost at the top of the hour. Have one more question from anyone. If not, I have one more for Lee, but I'll give everybody a second here. Okay, here we go. The possibility of truly irrevocable contracts between parties, even countries that don't trust each other, is touted as the advantage of crypto technology. Any comments? Yeah, these I would. I mean, I'll defer to Lee because he's an attorney. But I think that this idea of irrevocable contracts that you enter, in particular smart contracts, they are, since they are self-regulating to some extent, each one is already plugged into a certain wallet, and they have, they already have conditions built into those that you can't reverse. So the idea of, I mean, this idea of replacing trust with this type of technology, I mean, that was in the white paper. That was something that was, that was keen to begin with. And I do think that facilitates a lot of things. That facilitates a much more global environment to deal with this idea of replacing trust in this particular way. But I'll let the last word. I'll give the last word to Lee on this.
Well, at this point, I would encourage everyone to take a look at what happened with the DAO, or the DAO, the Decentralized Autonomous Organization, which led to the creation of the split, the fork in the Ethereum blockchain. So the whole premise was that this was essentially a decentralized venture capital fund, right, executed via a smart contract. Unfortunately, there was a flaw in the code. Some of the tokens got stolen, and then the question was, well, what do we do? And so this is to Jeff's point about is it irrevocable or not? Nothing is irrevocable on a blockchain, provided that 51% of the computing power thinks that it should be revoked, and that's effectively what happened. So there's a lot of governance challenges. Maybe we can put this on the agenda for next time, Jimmie. So these things are not as irrevocable as many would like to believe. And the essence of human nature is that we have disputes. We don't always agree, and that's why we have courts to adjudicate it. And smart contracts aren't going to bypass that anytime soon, in my opinion.
I look forward to talking about it next time. Hey, everybody, thanks very much for your questions. Always fun to do this. Lee and Bridget, thanks for the day.
Thank you, Jimmie. Thanks for organizing, Bridget, and thanks everyone for attending. Good to see you.
Thank you.